So the only cover that the banks will have and the Fed will have is if we have a recession/depression by the start of 2024. Now, that will enable the Fed to lower interest rates slowly and with reticence. However, I don't know if that's really good news for the stock market or banks.
Once, shame on you, fooled me 775 times, shame on me type of deal where, we're right there at the moving averages, we're right there at the cup and handle, all the technical indications, all of the convergence of the rising wedge, and all of these technical indicators say we're right there.
Yeah, realize we've got gold above $2,000, just below it in the spot market. And that is those premiums continuing to remain in gold pricing.
In today's episode, three financial experts, Andy Schectman, Michael Pento, and Gary Wagner, will talk about everything you need to know from a fundamental perspective about gold, silver, and the money markets. In today's show, we'll cover the current premiums in the precious metals sector, what's expected to happen next, and how everything is related to the current situation in the money markets and the raising debt that could kickstart the biggest bull run in history for precious metals. Like, subscribe and turn on notifications so you do not miss out our videos, and check the links in the description to get the best sign-up bonuses with our official partnership deals. Let's get into the episode.
Fed keeps raising interest rates. They might be done. I think there maybe have one left, but they're probably done. But we're at 5.25% on the Fed funds rate, 5.3 effectively on the effective Fed funds rate. But that's short term. The longer end of the curve is coming up, right? So rates are rising rapidly, even out on long duration. So these assets that were parked at the Fed are further underwater than they were when they first went there. So if Powell gives them back to the banks, these banks are going to be going bankrupt one after the other. So he can't do that. So what he's probably going to end up doing is rolling over these assets, which has inflationary implications. Because in effect, then isn't he then monetizing this debt again? So you either have you're either going to have a recession, depression, and rapid deflation, or you're going to have runaway stagflation like we've never seen before. That's where we're headed. Either one, it's binary because you can't have it both ways. The economy can't exist when real interest rates are positive. There's just too much debt outstanding. Government can't fund itself. Corporations can't survive. The real estate market can't withstand where, the real estate market is higher today than in 2006, the prior apex. And I don't mean just nominal prices. Of course, that's true. But as a percentage of income, the real estate market is out of reach. The real estate market is frozen. So we have dysfunctional markets because they're all artificial. How does that change? You have to let the market function properly. In other words, you have to let asset prices fall. And that's gonna entail a recession or a depression. And then the Fed will cut rates, and then the banks will heal. But you're going to have this cathartic cleansing, purging of asset prices.
Now, Gary Wagner will tie what Michael Pento just said about the money markets to explain you the current situation in the gold market and his expectations for next year.
That when these events initially occur, you get a knee-jerk reaction in which gold will move up substantially. We got that when Russia attacked Ukraine. We got that during the Israeli conflict that's currently underway. And then after a while, it seems as though market sentiment says, well, we've added the premium, and they begin to discount any news that's coming out from that geopolitical hotspot. So that's why we saw gold move as high as 2019 and then run back down, but yet the Middle East tensions were still fully in place. It seems as though market participants will want to shift their focus. In the case of what we saw, the shift in focus was to the Federal Reserve and whether they'd raise rates or whether they'd continue to pause. Once it became evident that a pause or rate hike conclusion is most likely, then we saw them really focusing on that because the Ukraine war is still fully in play, but they have added a premium to that. Realize we've got gold above $2,000, just below it in the spot market. And that is those premiums continuing to remain in gold pricing. I think that we could see profit taking occur at any point, especially on Thanksgiving. I get concerned because a couple of years back, we saw some traders in London take advantage of the long Thanksgiving Day holiday. And when the Americans were away and stuff with Turkey and the Canadians were away, so to speak, they really trashed the market, bringing it down substantially. But overall, I'm exceedingly bullish. I would look at any dip to be shallow and short term. I would look for 2000 to become support, major support at 1960. In terms of levels of resistance, it will have to challenge 2040 if it goes beyond, and that's a double top. Goes beyond that, 2080, and then the all-time record high is touching $2,100 per ounce. So I would think that it should go through at least one, if not challenge two of those levels, meaning 2080, before traders step in to pull profits.
Gold headlines today are skewed towards its upward trend, marking a fourth consecutive gain on Tuesday and reaching a 6-month peak supported by a weakening dollar and expectations that the U.S. Federal Reserve has concluded its interest rate hikes. The price of spot gold rose by 1.4% to $2,041.55 per ounce, the highest since May 10th, while U.S. gold futures for December delivery settled 1.4% higher at $2,040. The outlook for gold remains positive in the short term as the dollar index is on a downward trajectory amid optimism that the Fed may not raise interest rates further and could potentially cut them by spring, according to Jim Wyckoff, a senior analyst at Kitco Metals. However, Wyckoff cautioned that stronger than expected U.S. GDP numbers and inflation indicators could dampen enthusiasm for bullion among traders. Fed policymakers seem inclined to maintain current interest rates and possibly consider a cut in the future, with lower rates reducing the opportunity cost of holding non-interest-bearing bullion. Fed Governor Christopher Waller expressed confidence in the current policy stance. The dollar index touching its lowest point since mid-August makes bullion more affordable for international buyers. Investors are keeping an eye on Thursday's U.S. personal consumption expenditures PCE data, the Fed's preferred inflation gauge, and the upcoming revised U.S. third quarter GDP figures. Now we'll show you clips of Andy Schectman and his insights for the silver markets. Remember to like the video and subscribe to keep us motivated to do more videos like this.
We will see the price move into a territory where it actually deserves to be. I mean, you mentioned just at the onset here that you were on a site visit. You were visiting a mine in Mexico, and I think that's interesting because if we look at that from standpoint of what's been going on with mine supply, we read from the Silver Institute that silver mine production fell to its second lowest year ever over the past 10 years, with the exception, I think, of last year, which was lower, if I'm not mistaken. But at the same time, industrial demand grew to its highest level ever. So you have a weak supply and a very strong demand. Not to mention, the last 3 years have been really hallmarked in this industry by silver demand, more so than gold. So you have industrial demand rising, you have monetary demand rising, and according to the Silver Institute, you have mine supply, falling for the second year in a row. And I'm not going to comment on the Pickaxe article other than to say, the Pickaxe wrote a very compelling article about silver's role in the military-industrial complex as well. And all the demand for silver that is growing in a world where wars aren't stopping, where green and digital aspirations and utilities are not ceasing, where people are questioning fiat currencies. And I think in many respects look at silver not as an industrial metal, but as money. It is ridiculously, and this is all evidence that it is ridiculously priced too low, in my opinion. But it hasn't translated yet into rising premiums, into decreasing availability, or into an increased awareness to the mainstream. Shockingly, it hasn't.
Thank you for watching the video till the end. Hope you've learned a few things with the experts that have shared their insights and experiences. You're the backbone of our success, and your opinion matters to us. Let us know in the comment section, what do you think of today's episode? And I see you next time.